Good morning, everyone. Anthony Iser with another ITPM Flash here. Well, I'm going to talk a little bit about tariffs today, but not enough to bore you. And I'm not going to go into the nitty-gritty of why they're a tax and why they're bad, other than to say they are, and they add to uncertainty, confusion, and that's what's going on in markets at the moment. There was expectation today from Commerce Secretary Lutnick that tariffs on Canada and Mexico were going to be rolled back. Hasn't happened yet, might happen later on. There's commentary from the Ford CEO saying 25% tariff, which we've got on Canada and Mexico at the moment, would blow a hole in the US auto industry. So there's all sorts of negative issues. And the biggest thing really is it just adds confusion. So I've got here, you can see highlighted the comments around tariffs in this week's ISM data. So the commentary here, you can see uncertainty regarding tariffs, the incoming tariffs. These stop businesses making decisions with comfort and ease. Now, I'm not going to try and pick a trade that's going to benefit or be hurt from tariffs specifically, because it's all too hard. We don't know how long they're going to be on, what they're going to do. But I am looking at one that falls into that category, but has a whole bunch of other reasons why. So the key thing is we've got this big issue. Maybe you can find some specific little things, some wood importing company from Canada, perhaps. But there's easier ways to go and find it where we've got multiple tailwinds, or in this case, multiple headwinds. Now, just to finish up on tariffs, one of the biggest issues is you get these retaliations going on. So you can see here, Canada talking about power tariffs on imported power in the northern states of the US, where they get power generation from Canada. All these things add uncertainty. And just a graph here showing sort of where the US is going back to the 1930s, basically. And it's really strange to see the world's largest economic power has a license to print money. It's the reserve currency, going back to wanting manufacturing nuts and bolts and various things. But there you have it. Now, the key thing with all this, there is an economic impact. And you can see here from the Atlanta Fed, their GDP now is showing Q1 of this year, so the one that we're just finishing at the end of this month, as being negative. Now, there is specific data in here, and I won't go into all the nitty-gritty, but there's gold imports and various things that should be split out. But it clearly is negative, and we might have a negative GDP print. At least some people are thinking that. All of this, even if it doesn't come through, is going to add to uncertainty. And you can see that further in the volatility we've had in markets. And Goldman here has a chart they put out very regularly showing risk on and risk off. The dark blue triangles are risk off. That is the current number. And you can see it's all moving towards risk off. People are becoming a little more risk averse with this uncertainty. So enough on boring old tariffs. It's very tricky to try and pick winners and losers with all this volatility. What I'm trying to find is a sector that is going to either perform very well within this volatility or negatively. And I'm looking at housing. Now, there's a bunch of reasons why, and I'll go into those now. And also I'll talk about the macro of housing, what's going on with the sector, and why I've picked Lennar as my short idea in this housing sector. Firstly, for those people who don't know Lennar is a $32 billion market cap, largest housing builder in the US, more to the bottom end of the market in terms of socioeconomic. So you've got Toll Brothers up the top, $1 million plus houses, mostly paid for in cash. Average Lennar house is somewhere in the sort of $440,000 a year. And that's important as well, because what's going on with tariffs and the US economy is going to disproportionately impact the middle class. That's where the job cuts are going to come from. And that's going to be a negative for housing and for Lennar. So looking at their outlook and earnings, you can see here the sales forecast for the next 3 years is roughly in line with GDP, and inflation. 4%, 6%, 4% is the sales growth. Pretty steady, seasonal, as you would expect. So stronger sales running through in the last 3 quarters. This first quarter, traditionally quite weak. What we do know, though, as well, is there's been an impact from business operations. And I'll get into some of the detail on this. So you can see here, the forecast for 2025 has EPS down 11%. So we've got the top line holding in together reasonably well, 3 or 4%, but we're having some impacts lower down. And I'll explain why that's happening and why I think it's going to continue. So firstly, these companies are impacted by tariffs. Recent survey of home builders, 87% said they'd be negatively impacted by tariffs. And that is from a whole bunch of reasons, whether it's costs, whether it's labor, whether it's volume. There's a whole range of impacts that are going to flow through. And the key things that I really want to focus on is revenue risk. Now, any mentee that I've worked with knows that I'm very focused on looking at revenue. And what is revenue? It's simply price times volume. And in this state at the moment, it's very hard to see price going up. How are they going to go around the market and say, we're putting all our prices up? $440 last year, we're making it $460. So it's hard to see where revenue growth is coming from in terms of price. So it's really going to have to come from volume. And I think volume is at risk. The outlook from Lennar was pretty weak in the last quarter. And I think there's potential for that to flow down through from the revenue line all the way down to the net income line. So why is volume under pressure? Firstly, demand is going to be falling. We're seeing increased costs, as this chart here shows. The monthly breakdown, the cost of owning a home in the US at the moment has never been higher. Despite everything that's been going on, we've had a couple of Fed rate cuts. There's outlook for 3 more this year. The costs have not come down. That impacts demand, supply and demand, volume. There you go. That's having a major impact. Adding to this impact on demand, consumer confidence is coming through at a low level. Impact from inflation from the last few years, impact from tariffs and uncertainty, but more importantly, impact from job cuts. So we're seeing the big cuts that the Trump administration is trying to get through in terms of the federal government. Those job cuts are starting to have an impact, and they have an impact directly. I've lost my job. I can't afford my mortgage. I need to sell my house or find a new job. There's a big indirect impact as well. You're at the barbecue, you're at a bar, you're at the football, wherever it might be. You've got a friend who lost their job, or you know someone who has. It reins in spending and it reins in decision making on big acquisitions. And the biggest acquisition you can make is buying a house. So demand is going to come through weaker than expected, is my expectation. And as I said, that chart here shows monthly costs are at record highs. Until we see that coming down, there's not going to be too many people out there saying, I think I can afford to, go and upgrade my house. The US is not blowing up just yet, but the consumer is under pressure. And we're seeing that from results from Walmart, from Best Buy, a whole bunch of companies. And I expect to see that continuing. Second impact on volume is changes to immigration policy. 13% of construction workers are undocumented. You've got slowdown in building, and so the supply of housing, the ability to produce them, to sell them, is going to slow, and that's going to impact the outlook. A lot of stories at the moment about Iser raids happening in various industries. Construction is a key one. Documented and undocumented workers all a little bit worried about getting deported. That's going to have a continued impact on volumes. So price times volume, it's hard to see how that revenue line grows. And it's not really forecast to grow too much. This first quarter, you can see here, expected to grow 1.78% over the first quarter last year. Second quarter, down slightly on the second quarter last year, before a recovery later in the year. I think there's risk to these numbers in the short term and potential downgrade to guidance in the future. And it's worth noting, a lot of companies will use tariffs as an excuse, I think, in these reporting season coming up. And I might explain that further in another episode. Okay, another reason to look at Lennar over some of the others, they've got plenty of Florida exposure. Florida grew rapidly over the last few years. Hurricanes, cyclones, bad weather, lack of insurance are seeing a lot of existing homes come onto the market. Tougher market to be selling, tougher market for them. And then the final point that I wanted to make before I start looking at trade structure here is what I spoke about earlier, that flowing from the top line, so potentially a weaker sales number, and down. And you can see here in the last quarter how this unfolded. So we had top line sales growth 5.46%, but the gross profit fell year on year 17.18%. The reason for that, higher costs. Within all of that, all these incentives they're trying to do to get that volume up. So prices staying okay, trying to get volume up, but sacrificing margin, offering cheap financing, for example, offering fit out packages that the builder, in this case Lennar, is going to wear. And you can see down to the EBITDA line, down 20%. The forecast for the next few quarters highlights that pressure that they're facing. So top line, 1.78% growth, 3.11 decline, followed by 10% growth. At the gross profit level, down 11%, down 15%, and flat. And then down 26, down 20, down 7. So you have this negative cascading thing if they impact at the sales line negatively. And I think that's a risk. And I think the risk is, in addition to that, that the outlook might be reasonably weak. We might not need to see all of those though, because I'm looking at a trade structure here. The stock's around 122 today. The results are out on the 14th of March. So I'm going to buy March 115 puts, and I'm going to sell 110 puts in a spread. It's a pretty tight little narrow range, not necessarily something I would normally do, but at the Institute, we'd like to see a 3-to-1 payoff if we're doing a vertical spread, whether it's a bear put spread like this or a bull call spread. I can get a 3-to-1 payoff here. My cost $125. The difference between the strikes is $5. 3-to-1. I've got a week and a half to wait for the result. I've got 2 weeks through to expiry. I only need the share price to fall about 7 or 8% from where it is now. 10%. So 10% would get my full 3-to-1 payoff. If it's any more than that, that's fine, and may well be. But in this volatile sort of market, I think that return stacks up pretty well. So you can see here how we can take a big issue that's murky and cloudy, but you know it's there, like tariffs. We can try and find a sector that is going to be impacted negatively. We find that there's a whole bunch of other things going on in that sector as well. So if we can follow that chain down, get those tailwinds, if it's a stock that's going up, or in this case, a whole bunch of headwinds, the risk is to the downside. The probabilities are on my side, and the trade structure allows for a better payoff, 3 to 1. So there you have it. Lennar short, results out next week. Thanks.